So what if the reason you haven't hit your biggest financial goal has absolutely nothing to do with inflation or the stock market or even your income?
Yeah, it's a really sobering thought, honestly.
Right. What if you're just running on a faulty, invisible operating system and the market is just like exposing your bad code?
I mean, we pour so much energy into analyzing external data points, like interest rates or corporate earnings. We just completely ignore the internal software processing all that data.
Exactly. And that internal software is exactly what we're upgrading in today's deep dive. So I want you to think back to the 1999 film, The Matrix.
Oh, classic.
Yeah, so the protagonist, Neo, is sitting across from Morpheus, and he's offered this fundamental choice, right? He can swallow the blue pill, wake up in his bed, and just believe whatever he wants to believe in this comfortable, fabricated illusion.
Or he can take the red pill, stay in Wonderland, and see reality exactly as it is, no matter how jarring that truth is.
Right, the ultimate choice between a comfortable lie and a really difficult truth. And
Oh.
today, we are taking the red pill and applying that exact choice to your portfolio, your career, and your mind.
And we're pulling from a seriously dense, multi-layered source for this.
Yeah, it's Van K. Tharp's book, Trading Beyond the Matrix, The Red Pill for Traders and Investors. It's a 432-page beast, published in 2013 by John Wiley and Sons.
And, it's not your typical how to get rich in index funds kind of manual. Tharp was a very unique figure. He actually earned his PhD in psychology back in 1975.
Right, but he didn't stop there. He became a master practitioner of neuro-linguistic programming, or NLP, and a master timeline therapist.
Which, just to give some context, NLP is essentially the study of how our language and thoughts create our neurological patterns and how we can consciously reprogram them.
And timeline therapy is related to that.
Right. Yeah, exactly. It's a technique used to sort of unearth and release unresolved negative emotions that are rooted in past events. So Tharp took this really deep behavioral restructuring and just applied it directly to the absolute chaos of the financial markets.
And his overarching thesis basically throws traditional finance completely on its head. He argues that consistent profitability doesn't come from picking the right stocks.
No, not at all.
It's not about having the fastest algorithm either. He says the path to success actually lies in transforming your level of consciousness.
Which sounds wild at first.
It does. Okay, let's unpack this. Because leaping from buy low, sell high to, transform your consciousness sounds like we're skipping a few vital steps there.
We definitely are. And Tharp actually structures this transformation across 3 distinct levels. But he's very clear that you cannot successfully upgrade your consciousness if your basic operating framework is fundamentally broken.
Like, the spiritual work means nothing if the math doesn't work.
Precisely. We have to start with the hard logic, the foundational code before we touch the user interface, so to speak.
Right, so what is that first level?
Tharp calls this first level the transformation of the trading game. The whole premise is that there are 2 sets of rules in trading. The first set is the mechanics.
The systems, the technical analysis, the risk math.
Exactly. And then the second set is the psychology, your beliefs, your emotions, your self-mastery. And the tragedy of the retail investor, according to Tharp, is that they spend 99% of their time searching for the perfect mechanical entry point.
And like 0 time on the psychology.
Yep. They want the magic stock tip, not a mirror.
Wow. Okay, so to bridge this gap, he introduces something called Tharp Think, which I have to admit sounds a bit like a corporate branding exercise.
It does sound like a seminar catchphrase, but it's actually a really rigorous, mathematically derived system. He built it by modeling some of the most consistently profitable traders on Earth.
And the cornerstone of Tharp Think is position sizing, right?
Right. Now, most people understand basic diversification. Don't put all your eggs in one basket.
Sure. Basic Finance 101.
But Tharp elevates this to a strict mathematical discipline. Position sizing isn't about looking at a stock and saying, I like this company, I'll just buy 1,000 shares.
Oh, what is it then?
It is the precise calculation of exactly how much capital you're willing to risk losing on any single trade relative to your total equity.
Okay. So instead of thinking in terms of shares or absolute dollars, you are thinking purely in terms of a risk percentage.
Exactly.
So if my rule is I never risk more than 1% of my total portfolio on a trade, my position size shrinks or grows based entirely on where I place my stop loss.
That is the mechanism, yes. The objective isn't to get rich on one lucky guess. The objective is just to ensure you survive the inevitable statistically guaranteed losing streaks.
And that brings in the concept of reward to risk ratios, which kind of blew my mind.
Yeah, this is where it gets really counterintuitive. Tharp demonstrates mathematically that a trader can be wrong the majority of the time. Like, you could literally have a win rate of only 40% and still generate massive wealth.
I feel like this is where the standard school grading system completely ruins our intuition
Oh, completely.
because we're taught that 40% is an F, it's a failure. But in trading, if your risk is strictly managed, your losses are just small, calculated paper cuts.
Yeah, they're just business expenses. And to track this, Tharp uses a metric called R multiples. R stands for your initial risk.
Okay, break that down for me.
So if you risk $100 on a trade and you get stopped out, you have a -1 R multiple. But if the trade works and you make $300, you have a positive 3R multiple.
Oh, I see. So if you're winning trades average a multiple of 3 or 4, and your losing trades are strictly capped at -1, that 40% win rate suddenly produces an incredibly profitable system.
Right. Over a series of 50 or 100 trades, the math just takes over. And he wraps all these R multiples into one overarching grade called the SQN.
The system quality number.
Yes, the SQN is a proprietary metric he developed to evaluate the actual mathematical quality of any trading system.
How does he calculate it? It sounded pretty heavy on the math.
It is a bit. You take the average of your R multiples, divide it by the standard deviation of those R multiples, and then multiply by the square root of the number of trades.
Okay, that sounds incredibly
It
complex.
sounds like a lot, yeah, but it just outputs a single number. An SQN between 1.6 and 2.0 is average. Anything above 2.5 is excellent. And above 3.0 is what he calls a holy grail system.
And conversely, I assume a negative SQN is really bad news.
Yeah, a negative SQN means your system has negative expectancy. You are mathematically guaranteed to lose money over time, no matter how lucky you get in the short term.
And he backs this up with some pretty wild real-world case studies in the book, right?
Right.
Like David Witkin.
Yeah, David Witkin is profiled as having used these specific mechanics to generate a 130% return. And he explicitly stated it was just the beginning of his system's capability.
And then there's Rick Freeman, who went from being a standard commercial loan officer to a completely financially free trader using these exact metrics.
The math works.
But wait, if his entire thesis is about psychology and the matrix, starting with pages and pages of heavy formulas for R multiples and standard deviations just seems completely counterintuitive. Why not just start with the mind?
What's fascinating here is the concept of cognitive load and what Tharp calls the automation of Tharp think. You cannot reach higher psychological states. You can't be calm and centered if your underlying system is mathematically doomed.
Right, you can't meditate your way out of a negative SQN.
You really can't. If your system have a negative expectancy, your anxiety is completely justified. You should be stressed because your money is literally evaporating.
So you have to fix the math first.
Yes. Tharp argues that you must internalize the mechanics, the position sizing, and the R multiples until they just become automatic reflexes. Once the math is fundamentally sound and automated, it frees up your psychological bandwidth.
Ah, so you no longer worry about the basic survival of your account.
Exactly. Which means you can finally tackle the real demons.
Okay, so let's say you've perfected the math. Your system is bulletproof. You sit down to trade, the market dips slightly, your pulse skyrockets, and you manually override your own system to panic sell at a loss.
Which happens all the time.
All the time. The math didn't fail you there. Your brain did. Which takes us out of the mechanics and into level 2, reprogramming the internal matrix.
And this is where Tharp really integrates his NLP background. Level 2 is built on the realization that we live in a reality shaped entirely by our subconscious programming.
He maps this out using a belief hierarchy, doesn't he?
He does. So at the very top of the hierarchy are your core identity beliefs. Who you are, your worthiness, your overall worldview. And these top-level beliefs cascade down and dictate your highly specific beliefs about the market.
He actually states quite plainly, quote, "Understanding the impact of beliefs will change your life."
Because a flawless SQN cannot overcome a belief that money is fundamentally evil or, that you don't deserve success.
Right. The top-level programming will always find a way to sabotage the execution just to align with that core belief.
Which leads to his central philosophical point, and this is huge. Everything has the meaning you give it.
The market itself is entirely neutral.
Exactly. A chart ticking up or down is just data. A financial loss is not inherently bad, and a financial gain is not inherently good. Those labels only exist when we project our own internal meaning onto the neutral data.
To explain how this sabotage actually happens, he introduces this concept of the parts party. He argues that we aren't actually a single unified self. We are a crowd of conflicting parts inside.
It's a great visual.
I love visualizing this as a chaotic corporate boardroom inside your head. You've got the reckless risk taker in a flashy suit yelling at the terrified conservative accountant who's like hiding under the table.
And they're literally wrestling for control of your mouse click.
Exactly. It is a chaotic scene for most people.
hmm
So how does Tharp suggest we handle that?
His solution is a process called parts negotiation. So let's look at how this works in real time. Say you're in a trade and the stock suddenly drops sharply. Your chest tightens.
The terrified accountant in your mental boardroom starts screaming to sell everything immediately,
Yeah.
totally violating your trading plan.
Right. And most people either blindly obey that panic or they try to brutally suppress it, which honestly only makes it louder next time.
So how do you negotiate with a screaming accountant while a stock is crashing?
Well, you pause and you acknowledge the part. NLP teaches that every behavior, no matter how destructive it seems on the surface, has a positive underlying intent.
Okay, so you mentally isolate that panicked voice.
Yes, and you ask it, what is your purpose? The accountant might answer, I'm trying to protect our life savings from being wiped out. So you validate that intent. You thank it for trying to keep you safe.
But then what? You still have a plunging stock.
Then you introduce it to the math. You remind the accountant of the position sizing rules you established in level I. You show it that the maximum loss is strictly capped at 1%.
Oh, wow.
Yeah, you negotiate an agreement where the accountant steps back, knowing safety is already mathematically handled by the system.
So you are effectively calming the nervous system by proving that the threat isn't actually real.
Exactly.
But hold on. If a massive financial loss isn't bad unless I decide it is, how is that not just toxic positivity or straight-up delusion?
That's a fair question.
Like if a trader loses their life savings, the bank doesn't care about their belief hierarchy. They're still going to foreclose on the house. That is an objectively bad scenario.
Sure, but Tharp is definitely not advocating for delusional optimism here. He isn't suggesting you smile warmly as your account drains to zero or pretend a foreclosure is a blessing.
Right, okay.
The goal is neutralizing the emotional hijacking. When you label a significant loss as, say, a catastrophic failure that proves I am worthless, your brain enters a fight or flight state. Your amygdala just completely takes over.
And that's when you make irrational decisions like revenge trading to win it back, which usually just compounds the error.
Precisely. You are quarantining the emotion from the logic. If you can reframe the loss as a neutral data point, saying to yourself, this is just a -1R multiple event, which is an expected statistical outcome of my proven system, you stop the self-sabotage cycle.
You retain your logic. You don't have to be happy about losing money. You just have to prevent the loss from triggering a riot in the boardroom.
Right. By changing the meaning, you keep the executive function of your brain online.
So the boardroom is finally quiet. The accountant and the risk taker have signed a peace treaty. Your beliefs are aligned with your math. Once you achieve that baseline of internal silence, what is the ultimate end state? Where does this all lead?
It leads to level 3, which is the final and undoubtedly the most controversial section of Tharp's methodology, trading in the now and moving beyond the matrix entirely.
And this is where he takes a really hard left turn from clinical psychology into straight-up spiritual territory.
He really does. Level 3 transitions from psychological repair to an actual elevation of consciousness. Tharp categorizes fear, greed, and anger as low levels of consciousness.
And the ultimate goal for a trader is what?
To ascend into higher states characterized by acceptance, peace, and eventually enlightenment.
He genuinely uses the word enlightenment as the ultimate goal of a financial trading book.
He does.
He writes that you want to become so fully present that your ego, with all its desperately attached fears, hopes, and desires, essentially disappears. His exact words. The goal is to observe what the market is doing right now with no interference of any kind.
It is the ultimate application of mindfulness to capitalism. Total, unbroken presence. But, as you can imagine, this approach generated significant friction within the traditional financial community.
It definitely alienated some readers. While a lot of reviewers praised the elegant blend of cognitive psychology and risk management in the first two sections, the third section felt a bit alienating.
Yeah, one critic was quite vocal, writing that they found it, quote, disturbing that the science of psychology is being hijacked by New Age philosophy.
The contrast is stark, to be fair. You begin Chapter 1 calculating actuary-level standard deviations for SQNs, and by the end of the book, you are aiming for Zen Buddhist detachment from material reality.
It's quite a journey.
But here's where it gets really interesting, because I completely understand the critics' hesitation. Does a guy day trading oil futures in his home office really need to undergo a major consciousness transformation and achieve spiritual enlightenment?
That's the big question.
Doesn't he just need some brief cognitive behavioral therapy to figure out why he rage trades after a bad morning? This feels like using a spiritual sledgehammer to crack a very small practical walnut.
If we connect this to the bigger picture, we can see the distinction Tharp is trying to make between symptom management and a total cure.
Okay, go on.
Brief therapy might stop the most obvious destructive behaviors. It might get the guy in the flashy suit and the terrified accountant to stop throwing chairs at each other. But standard therapy usually leaves the ego intact. It just makes the ego slightly more manageable.
So the ego is still sitting at the head of the boardroom table. It's just speaking in a quieter voice.
Yes, exactly. Tharp draws a very specific line between what he calls the awakening trader and the transformed trader. The awakening trader is someone who has taken the red pill, recognizes their self-sabotaging patterns, and is actively negotiating with their parts.
But they still feel the urge to panic, right? They just use tools to suppress it.
Right. The transformed trader, on the other hand, doesn't feel the panic at all. Tharp argues that total presence observing reality without any underlying expectation of what it should do is the absolute only way to flawlessly trade probabilities.
Let's ground this in a specific scenario. It's 9:30 a.m. on a Tuesday. The opening bell rings, and a core position in your portfolio immediately tanks on unexpected news.
Okay, classic stress test.
The awakening trader watches the red candles form, feels their heart rate spike, hears the inner accountant start to hyperventilate, and has to consciously employ their NLP techniques. They have to actively negotiate themselves out of making a mistake.
And that takes massive energy. But the transformed trader, operating from that higher state of consciousness, watches the exact same red candles form on the screen. There is no spike in heart rate.
There is no boardroom riot.
None. They simply observe that the price has crossed their mathematical stop-loss threshold, and they click sell with the exact same emotional detachment as taking out the trash.
Wow.
Because if you have even a sliver of expectation or ego attached to the trade, you are trading your own emotional baggage. If you secretly need the market to bounce back to validate your intelligence, you will subconsciously ignore the data telling you to sell.
So what does this all mean? We've covered a massive amount of ground today. We started in the rigid mathematical mechanics of level I automating your risk through position sizing, embracing 40% win rates with R multiples, and proving your system's worth with SQNs.
Yep, the hard math.
Then we moved into level 2, taking the red pill to face our internal belief hierarchy. We learned how to quiet the chaotic corporate boardroom in our heads through parts negotiation and stripping the toxic meaning away from neutral market movements.
And then level 3.
Right, finally exploring level 3, where the ultimate goal isn't just a quiet mind, but a state of pure presence, an egoless, peaceful acceptance of reality in the now.
It really reveals that taking the red pill in finance is actually a journey of extreme, radical self-accountability. The market is never doing anything to you, it is just reflecting you.
And the beauty of Tharp's framework is how easily it escapes the trading terminal. I mean, the mechanics of risk management, the acute awareness of our own self-sabotage, the daily pursuit of presence, these are just fundamental life skills.
Absolutely. Think about navigating office politics or managing a complex relationship with a family member. Your personal matrix is constantly projecting meaning onto totally neutral events.
Oh, for sure. Your boss sends a 2-word email. Your partner sighs heavily from the other room. Those are just neutral data points.
But your internal boardroom instantly assigns a narrative of fear, inadequacy, or anger to them. Tharp's work is a really powerful reminder that we have the ultimate authority to reprogram how we interpret the world.
We have to constantly ask ourselves, are we reacting to reality as it is? Or are we just shadowboxing with the ghosts of our own unexamined beliefs?
That's the real challenge.
Which leaves us with one final thought to mull over as you go about your day. If N.K. Tharp is right, and your beliefs act as the literal underlying programming for your reality, take a hard look at the media diet, the news, and the data you consume every single day.
Oh, that's a great point.
Are you actually gathering diverse information to understand the complex market of the real world? Or are you just actively downloading daily updates to keep your current comfortable matrix running smoothly? The red pill is sitting right there on the table. Which one will you choose today?